Hi, this is May 26, 2023. Thank you for joining me for this edition of FedWatch. It's been an interesting mixed week, really. The Fed released the notes from the meeting where they decided to push interest rates up that 25 basis points. And what was interesting to me was they actually had a debate on whether they should do it or not. And the vote came out unanimous, but at least there was a debate about it, which I find to be encouraging, really. Fed also came out with their first quarter, actually, it's an April release on their senior loan survey. It's an opinion survey. And I'm bringing that to you because the numbers were pretty stark in terms of the percentage of respondents reporting tightening credit, not only on commercial real estate loans, but also on commercial and industrial loans. Real estate, I expected the commercial industrial default rate is so low right now that kind of surprised me. But they're looking for a bigger spread. In other words, they want to make more money off of it, and it's a lower loan to book value ratio that they're looking for. Deals can still be done. I mean, I've been talking to bankers, and if you have a relationship with them, you can still get the deal done. But you will have needed that relationship going in, and you will need a compelling case. They're still in business. They still want to make money. It's just harder than it used to be. The second thing I want to talk about, and there are three, the second one is the money supply. New data came out, and we always follow that closely. It's the other aspect of monetary policy. You know, everybody thinks about interest rates, but there's the supply of money that matters greatly also. And you can see how it matters on this chart. We're looking at the 112 rate of change for the money supply, which is that thicker green line, and the 12 over 12 rate of change for retail sales, total retail sales in nominal dollars in the US. And the money supply leads by 16 months on median. And you can see what it's telling us about where we're going to be going with retail sales. Now, does retail sales, we're not expecting it to go quite that negative because the consumer, as we talked about, is in good income position. They're in a good balance sheet position. So it doesn't have to go that negative. There are still some savings out there. But it explains why retail sales went so high, and it explains why we're going to be under pressure on retail sales, at least through mid-2024, third quarter 2024. What we want to see, you and I really want to see, unless we want the recession to drag on, is the money supply 112 rate change to start turning up. And it could. I mean, rational thinking says that it should. That minus 9.2%, that's a record low. It's an amazingly negative number. It came off of an amazingly positive number. But even at that, it just shows you how the Federal Reserve has been given to extremes going on right now. We don't find that extreme behavior in Canada. Canada, the money supply surged, but not to a record high. It had been up to that level of rate of change numerous times. And it's, on terms of the money supply in Canada, instead of being minus 9.2%, it's still plus 4.1%. So the money supply is still growing in Canada, as opposed to actively shrinking here in the United States. Totally different fear factor really involved, expressed by our Federal Reserve and their central bank. The encouraging sign is the money supply raw data adjusted for inflation is now back down to where it was just before the COVID virus really hit this country. We're back to where we were in March 2020. That could mean, to a rational person anyways, that the Federal Reserve can stop with the cranking down on the money supply and start waiting to see how things are going to pan out before they decide whether they need to raise interest rates some more or lower interest rates some more. Third thing I wanted to talk about, though, and this is counter that expectation of rational behavior, was looking at the PCE price indicator without food and fuel. I mean, it's too bad they have to go without food and fuel because food and fuel are coming down. But looking at that, I mean, running the numbers out, you know, and we do a pretty good job of forecasting here. It doesn't look to us like the current trajectory is going to get us to that mythical 2.0% inflation rate, even by the end of 2024. And it's because of labor costs that we have talked about before. Other material costs are coming down, but the labor is a big component of personal consumption expenditure price index. And labor costs are not coming down. We're not likely to see significant decline in labor costs. So Fed may be looking at the wrong indicator and still may be pushing us into that more severe recession. I'll let you know when that number, the PCE trend, that number improves, or in this case, becomes steeper on the downside. So far, it's just typical, and we need to get to the lower side of normal if we're going to get to that 2% figure by the end of 2024. We'll keep you up to date. Right now, they seem to be taking a breather. There seem to be some discussions. There's reasons why they should let up on the money supply, and they're still questing after lower labor costs, which is probably the most damning thing of all. So thank you for joining us for this edition of Fed Watch. I'll see you next week.